All right. Well, welcome everybody to our local investment network workshop tonight on housing. We are really excited to have you with us. I'm going to give just a couple of tech details here. Please make sure that you are muted throughout the show tonight. If you have a question for Bill during his presentation, go ahead and post it in the chat box. And if we don't get to it, we'll make sure that we capture that and we'll get back to you after the seminar. If you have a technical issue, please go ahead and private message Cherie in the chat box. That Cherie reads spare. It's the logo that she's waving. So she can help you out if you have any technical difficulties. So I want to give a big thank you tonight to WSMA, the Washington State Microenterprise Association, the Association of Washington Cities, and WSU Extension. Also, thank you to the Washington State Department of Commerce for supporting this work. We're going to go ahead and get started. We know that housing has become a huge issue for local communities. And we have been meeting for the past couple of years, local investment networks around the state of Washington. And we have been talking about the issues in our communities, and housing has just risen to the top of the biggest issue in all of our communities together. So this is a joint effort. We decided to have this seminar tonight to dig deeper into how local investment networks can be involved in housing and what kind of solutions are out there that we can do. So I'm going to go ahead and have the local investment networks who are here tonight introduce themselves briefly. I represent the Methow Investment Network, and I'll go from there.
Aslan Mead with the Thurston Economic Development Council in Thurston County, and our network is the Thurston Investment Network. We call it THINK for short. So think local, invest local. And who's next on here?
Hi, I'm Earl Merman. I'm representing the LCIN network, which is in Jefferson County, Washington. There are a number of LCIN members present tonight. We have about 80 members and have been active since about 2012. And we've invested a lot in local businesses and nonprofits, and now affordable housing is really rising up quickly. So we're very happy to be part of this.
BJ Stewart, who is not here, from Urban Impact, a brand new local investment network, and he gives his best.
Hi, everybody. Good evening. My name is Anthony Grump. I'm with WSU Extension. And myself and my colleague, Trevor Lane, who's also with WSU Extension, we are here on behalf of WSU, and we are both faculty with the Community and Economic Development unit of Extension, and have been working on supporting the local investment network groups, and have put together a field guide for local investing and all of that. So it's great to be here with you. Thank you.
And I'll follow up with to Anthony. I'm Andy Meyer with the Association of Washington Cities, and AWC, as we are known, along with WSU Extension, have been working to try and spread the word about local investment networks for probably going on close to 10 years now in Washington State. And thanks to the partnership now with WSMA, with the Microenterprise Association, and with this growing community of practice of LINs around the state, we're happy to be here tonight and enter into this conversation with all of you.
Thank you, Andy. Yeah, so my name is Lisa Smith. I'm the Executive Director of the Washington State Microenterprise Association. And our partners, there are over 79 partners around the state, who are nonprofit microenterprise development organizations that walk people through the process of writing a business plan and accessing credit and providing technical assistance to the small businesses so they're ready for their pitch to the local investment network. So we're excited to be here and grateful for the opportunity to support this initiative. Thanks.
Right. So without further ado, I will introduce Bill Barberg. Bill is the president and founder of InsightFormation. He is a globally recognized expert in strategy management, collective impact, and balanced scorecard methodology. He is the author of a highly acclaimed chapter implementing population health strategies in the book Solving Population Health Problems Through Collaboration. He is a highly sought after speaker for organizations, communities, and coalitions striving to address issues that no one organization can address alone. Bill was the winner of the 2018 Health System Transformation Award for innovative work to advance collaboration around the opioid heroin crisis. So without further ado, I'm going to let Bill take it away.
All right. Well, I'm going to share my screen and we'll get started here. But it's great to have such a good turnout. And I'm excited to share this evening about innovative ways that local investment networks can support practical housing strategies and thriving local economies, things that would benefit everyone. So I'm going to briefly go over some of the needs, risks, and opportunities, but then spend most of the time going into 5 important innovations. And then we're going to be able to break out into groups, and these groups, you're pre-assigned to a group. There'll be quite a few different groups, and you'll have one of those 5 topics that you'll be discussing. And then you'll be able to come up and ask questions of me afterwards. So part of what you'll do in your discussion is come up with 1 or 2 questions that you might want to ask in the final part of tonight's workshop. So with that, the need for affordable housing is clear to a lot of people, but different people think of different things. One of the priorities in most regions is workforce housing, because you need housing to be able to attract and keep employees and teachers and other folks. There's also the need for starter homes that allow entry into home ownership, and they allow families to begin building wealth and creating stable communities. There's also a different set of needs where you have an aging population, and if they don't have an appropriate housing to move into, it becomes difficult for the region. Then you've got issues of people with very low incomes who can otherwise end up homeless, and that's not good for a community either. So the housing crisis is a lot of different facets, and there's no one solution, but there's a lot of things that can be done. One of the things that's a kind of a reality across the country is that you do have a lot of kind of aging baby boomers who normally would be selling their homes and moving into something smaller. And an estimate was a few years ago that there would be close to 1 million homes released each year by people age 60 or older for those reasons. But what's happened is not as many of them have moved as quickly, often because they didn't have good options. And as a result, that's been one of the many factors creating a shortage of housing. But a real challenge to think about is when they do sell their home, because eventually they will, who's going to be able to buy them? And this is concerning, where you have a growing number of homes that are being sold, being purchased by investors, and often investors from outside of the region, outside of the state, or even outside of the country. And when relatively low-cost housing gets snapped up by investors who turn it into rental properties, whether it's short-term or long-term rentals, that creates a lot of problems. It creates shortages, it creates bidding wars, and drives up the cost to make it less and less affordable for people to buy and more expensive for renters. But there's other problems that causes, in that distant owners and transient renters, they're not as committed to the neighborhood. They're not as committed to the social connections, or sometimes not as committed to maintaining the home or caring about the neighborhood. And that can lead to really deterioration of the neighborhood in multiple ways. You also have situations where speculative investors, as they see the price of houses going up, they're looking to just buy a home, possibly leave it empty for months, maybe make some improvements, maybe not, but just sell it in the future. Or you have people who buy it and say, I'd like to have a second home. I might as well have an asset that's appreciating. But that takes up the supply and makes it more difficult for people to live there. But the thing that most people don't give nearly enough attention to is the impact when every month rent payments are being paid to investors and owners who take that money out of the local economy. So it's not spent in restaurants. It's not building wealth for people who could spend it going to movies or other things. And so a lot of the other businesses in the community suffer. And you're actually starting to build in more structural poverty if that significant income is leaving your local economy. This whole thing is called the financialization of housing. And there was an excellent award-winning documentary called Push that talks about the financialization of housing around the world. And I encourage you to go to pushthefilm.com and watch this documentary. And it can be a great discussion point for some of your groups. They also have a powerful podcast series, and that's right on Push the Film. There's a Pushback Talks link. And I encourage you, go back to the beginning of the series and start listening to the first several or 10 of them. They're kind of discouraging, but it's really good information to know. That's the bad news. The good news is that with an appropriate strategy, there's the opportunity for housing to become an economic engine. And here's where it creates value. It builds wealth, it creates pathways to middle-class stability, to self-sufficiency, and it improves the quality of life for everyone in the community. A good housing strategy can lead to attracting and retaining the local workforces, you know, the teachers, healthcare workers, and such that need the workforce housing. It also can be a catalyst for local entrepreneurship that allows business owners to build wealth and create that thriving local economy where money then can be spent again and again with that local economic multiplier because you're building wealth in the community. A good housing strategy can allow you to revitalize older neighborhoods with what one person called communification, building the community rather than gentrification, which tends to displace people. And lastly, if you're building that local economy and you've got a housing ecosystem that's working, you're going to be reducing crime, poverty, you're going to be reducing carbon emissions because people won't have to drive as far to where they live, work, and play. You're reducing blight and you're reducing unjust disparities that, you know, all kinds of good stuff can come. But this is not, there's not a simple fix to this, but there are some really powerful things that can be done. So we're going to go into 5 topics and look at them specifically with how local investment networks can be a part of them. And so I've listed them here: using charitable capital to support thriving communities, how LCINs can create a successful ADU ecosystem, that's accessory dwelling units, navigating the risks and opportunities of short-term rentals, supporting innovative ownership models, and supporting a successful housing rental ecosystem. So those are the 5 topics, and then those are the topics you'll be in a breakout group for. Excuse me. As part of this workshop, the local investment networks have purchased access to the deep dive days from the Housing Solution Summit that I organized last year. And one of the key sessions is on accessory dwelling units. There's over 20 different sessions on a whole bunch of topics for accessory dwelling units that go deeper into what we'll just scratch the surface on today. And there's also a whole bunch of sessions on housing finance and ownership models. So there's a lot more depth that you can dig into by picking through any of these replay sessions that are available from the Housing Solution Summit. So if you need access to those, make sure you check with Julie or someone, and they'll get you access to view any of those recordings. But when you look at any of these things, resist the temptation to try to say which one is the solution. Are community land trusts the solution, or accessory dwelling units? No one of these things solves the problem. But think of these things as ingredients for recipes, and the different locales might have slightly different recipes, but having this good set of agreements allows you to create some really powerful strategies or powerful recipes. So this is going to start the conversation. It's going to start the learning. And a key thing here is that the local investment network's role is not to go in and solve the problem. They're just part of a larger strategy. So this is going to be most effective if you have other stakeholders coming together and looking at how they can play a role in a housing ecosystem strategy that intertwines with your local economic development, your health, your and other issues that are tied in with housing and economic development. Okay, the first category of ingredients is under the broad heading of charitable capital. Now, when we talk about charitable capital, this is not something that most of the local investment people are going to be putting their money into. They're generally not charities. They generally want a return on their investment. But in most communities and across the state, there are charitable organizations and individuals who make charitable donations. And historically, those get a minus 100% return. There's no expectation that they're going to get their money back or make a profit. On the other hand, there are for-profit investments. And the further you go to the right, you could get all the way out beyond what I have in the green circle, is where you might have the loan sharks and the predatory lenders. Hopefully you're not bad guys like that, but they're just taking advantage of vulnerable people and extracting as much profit as they possibly can. But in the green circle here, you've got market rate returns. Some of them might be more avoiding the right-hand side by saying, we don't want to invest in tobacco companies or companies that are doing things that we think are bad for our communities or world. Others might say, well, we'll take a little bit lower return. We'll move a little bit to the left because we want to do good, but we still want to get a decent return. Well, charitable capital is where you begin to bring these two together and say there can be charitable investments that have a below typical market return, but they do good. And they may have a higher risk. And a company it's a nonprofit that's been really a pioneer in this space is the Venn Foundation. And it says where charity and investing meet. So if you think of a hypothetical investment with a minus 50% return on investment, if you're a foundation or someone who's normally giving away donations or charity, you say, I'm going to get half of my money back. That's a pretty good deal. Let's do it. But if you're a for-profit investor, you say, I'm going to put my money in and expect to only get half of it back. No way. So it's kind of a glass half full or glass half empty. Well, some examples. Well, first of all, a lot of the initial charitable capital can be what foundations call program-related investments. So a foundation, to keep its nonprofit tax status, they have their investment portfolio, and of that, they have to give away 5% of that in grants every year. Beyond that, they can do whatever they want to do with their money. But that 5% that is a grant can be in the form of a program-related investment that gets paid back. And it can even get paid back with profit, but it just can't be something that would be a market rate investment and that would be acceptable to a market rate investor. So an example is you may have a charitable capital donation of $250,000, or it's an investment. And that $250,000 is put into a credit union as collateral, enabling the credit union to make $1 million loan to some fairly risky entrepreneurial business because they got $250,000 in collateral sitting in the account. As the two could both be paid off, and perhaps that loan that was made from the charitable capital gets a 2% return, but it enabled a business that otherwise wouldn't have been able to get capital to get a much, much larger loan. Another example, instead of lending to doing a loan guarantee or collateral for a business, it might be that individuals who are adding accessory dwelling units or who are even buying maybe a fixer-upper where their credit might not justify them getting a full mortgage, there might be a loan guarantee fund that makes another lender willing to lend them that money. So that would be another example of charitable capital in action. Or maybe it's startup capital for a worker-owned cooperative that builds accessory dwelling units, and the payback model is based on so many dollars for every accessory dwelling unit that they sell. And so if business is really good, it'll get paid back quickly. If it really struggles, it will get paid back over a longer time. And if the business fails, it might not even get paid back. So that's why it wouldn't be an investment made by a normal investor. Or it could be the highest risk part of the capital stack for building an affordable apartment complex, where it would take on the greatest risk and be combined with other sources of capital. Or it could be a loan to a land bank that's going to allow them to buy distressed houses quickly with the expectation that they would sell those to an owner occupant or to a community land trust, and then pay that money back to the charitable capital fund. But again, riskier than a typical investor would likely put their money in for, because they're not focused on maximizing their profit. It's about being agile in the real estate market. So how does this fit in with LCINs? Well, this is a de-risking strategy. Charitable capital can make a lot of beneficial investments less risky, so that local investors like you, who probably fit in the category of wanting to do good and wanting to make a profit, have the opportunity to do that. So the way charitable capital gets going is you have anchor organizations start with a program-related investment that might go into a Venn Foundation. They streamline the whole process. Then you have other charitable investors put their money into that fund. Then you have to create, ideally, an ecosystem like the housing ecosystem we'll be talking about, where you can create financial value and social good and design investments that have a positive return potential, but they're too much risk for market rate investors. You then build that over time as there's a return, hopefully, on the investments, as well as additional people putting money in. And that allows other socially oriented investors, like people in the LCIN, to be able to put money into community positive investments that are less risky. So that's the topic of charitable capital. And here's a few questions that you might be thinking about and talking about in your breakout group for charitable capital. Number 2 is how LCINs can help create a successful ecosystem for accessory dwelling units. And this is where I talk about having a larger strategy. And we encourage communities on many different topics to develop a strategy map. And the strategy map has the outcomes at the top. It has the strategy objectives that the community is going to work on together in the middle, and then what are called asset and capacity development objectives for the community. So this is not for a single organization. This is how a community is working together. And some of the outcomes, some of the reasons you'd build accessory dwelling units is that it's gentle density. It's increasing income to the homeowners because they may have an additional property that they can rent in their backyard. There's additional wealth building opportunities for people in the community, including middle and lower income homeowners. It increases the supply of small, affordable rental units, and it increases good housing options for seniors, because some of the accessory dwelling units can be ideally designed for seniors in terms of the layout and functionality that they have, and integrate telemedicine and other good stuff. So how do you increase the building of ADUs? Well, first, you need to improve the awareness and understanding of ADUs, because a lot of people don't know much about them. Backyard cottages, granny flats, and such. Many communities have to address zoning and code issues. There's efforts being done at the state level, but there's often local things where you need to clear the way to make this more doable. Then there's a whole bunch of ways we're going to look at that can reduce the cost of building ADUs, because the less expensive they are, the more the dollars work out. Then you want to improve financing and funding options for ADUs. And if a lot of these might be rented out in a person's backyard, it's nice to have rental management process support, because some people wouldn't mind having a rental property in their backyard and getting some money from it, but they don't want the responsibility of being the landlord. And then if you're especially dealing with seniors and an aging population, integrating telehealth and assisted living support services can really create a nice combination of people living alone, but still having the care that can come with assisted living and telehealth. Then at the bottom, it's about building a coalition that is working to make all of this happen. It's about diversifying some funding sources that can help with some of the infrastructure that might be needed, and aligning the interests of the health department, the mayor's office, the transportation, the businesses, to be able to create this thriving system. Now, if you saw the video that I recommended people watch in advance on the Tupelo miracle, you'll see how the system thinking can lead to amazing benefits, whereas everybody working in their own silos and being fragmented likely doesn't accomplish that. So just a quick, I'm not going to go into all the details, but if you zoom in on the cost of reducing the cost of building ADUs, these are some of the best practices that we've seen from around the country. Freely sharing the design and plans and pre-approving them for code compliance, and using manufactured ADUs and minimizing local fees and taxes. And you might say, oh, our city doesn't want to reduce the fees. But if, as part of the overall process, they can be much better off and you have more revenue and fewer costs if they're participating in doing their role. And there's an opportunity to create and coordinate bulk purchasing of materials, or working with schools or volunteers or Habitat for Humanity to help make the cost of adding ADUs less. So that's when those are some of the elements that you start weaving together in a community strategy. Now, the role that LCINs could play is if there is an ecosystem, you could be adding 100 or more accessory dwelling units a year. So there could be some investable elements, some startup companies that would build a shell of an ADU, or that would lay the concrete foundation and get all the utilities hooked up, or that would a loan to a building supply business that would know they need to buy a lot of the kind of supplies that people will want when they're building and upgrading accessory dwelling units. Even helping to launch a production facility for one of the innovative building system companies that would be right in your community, creating more of a factory type job that could then support the ADUs, or supporting a nonprofit or a B Corp that would do property management for people who have accessory dwelling units. So lots of different ways that finance, especially if there's some charitable capital to take away the risk, can support this. There's also ways to support parts of the ecosystem when it comes to people who want to buy an ADU. The local investors could choose to build and own and rent out the ADUs on somebody else's household lot and just pay a monthly lot lease to those homeowners. So an investor could say, I'm going to have 10 of these ADUs across my community, and I'm going to earn a nice monthly rental fee for that. I'm going to pay a portion of that to the local homeowners. And that's a way that you're building local rental units and wealth, and you're possibly sell it to the homeowner down the road. And then it would be building their own wealth and you'd cash out of it. So that's one option. Another option is the LCINs could make loans to the potential ADU owner occupants, where the ADU becomes a starter home that they can buy for under $100,000. And they're going to just need a loan, and a typical mortgage might not be a good option, but it could be a market rate loan that they would pay back. And you've got a loan that is built, allowing people to generate wealth. You're creating revenue for the homeowners who are renting, doing a lot lease for part of their property. And in the future, whoever owned that starter home, that ADU, they sell it. They've maybe got $50,000 in equity in it. If they've paid off half of it, that $50,000 can be down payment towards a full-size house. Other ways that LCINs can fit in is that you could make loans to homeowners who add an ADU in their backyard as a rental property. And there's different ways that that could be done. Or there could be loans that are made to a community land trust. And that allows the community land trust to buy a house, then they separate and keep the land and sell the house, but they also can add an ADU on that same property and rent out the ADU. So that creates some multiple revenue streams for a community land trust to begin to grow more rapidly. So again, combining some financing with some creative ownership and accessory dwelling unit models. So for the group that's discussing ADUs, you'll be talking a little bit about some of the risks and benefits and which part of the ADU ecosystem might be something that would appeal to you as investors. The third area where there's some real risks and opportunities involves short-term rentals, the Airbnb world. If in area as beautiful as yours, you're working to improve and expand outdoor recreation and attract visitors, that can be good for the local economy, except for the fact it can really mess up your housing ecosystem, because distant investors can buy up local homes and have them as dedicated Airbnb or other short-term rental properties, and their bidding to buy these houses to turn them into short-term rentals makes it less and less affordable for people who live and work in that community. And all the money that's being spent for tourism or for people staying in the short-term rentals may leave the local economy and go to Seattle or New York or Beijing, whoever's buying up those properties. And it often kind of weakens a neighborhood because you have all these kind of transient occupants. Other cases, people, they may take long-term rental properties and convert them to short-term rental properties because they can make more money, but that squeezes out seniors and workforce renters. So to counter that, you want to have a strategy that accomplishes a couple of things. So one of the places where short-term rentals has been devastating has been in many parts of Europe. Places like Venice and Barcelona have had just a lot of damage with Airbnb investors, people from all over the world buying up houses and turning them into Airbnb. Out of that came the launching of Fairbnb. Fairbnb is a co-op, and it's driving what they call community-powered tourism. And the idea is that using housing as a way to positively impact your community rather than negative. And there's three major differences between Fairbnb and Airbnb. Number one, you have to be an owner occupant. So you can't have investors buying up homes and just dividing them up into 3 or 4 Airbnb rooms. You've got to live there full-time in the home or in an accessory dwelling unit on the same property. Second, it's a co-op, so you don't have investors trying to constantly push to extract higher and higher profits. And third, half of the fee that they collect is donated back to locally designated projects. So it helps fund things that make for a better community instead of going to shareholders and investors. So it's primarily grown around Europe, but it's starting to spread to it's not in the United States yet, but I know the people who started it. I've been talking with them for the last couple of years, since before the pandemic, about bringing their model to the United States. And so this could be promoted as part of a regional tourism, outdoor recreation, marketing campaign that says, when you come to our part of Washington, stay in Fairbnb. That's going to make everyone's going to win. It's going to be less expensive for you. We've got more space. We can build this positive system. And so homeowners that have an extra room can rent, and that they might need a loan possibly to do some minor renovations, and that would be something that the LCINs could support to say, hey, if you want to be part of Fairbnb, you can get a short loan to help, and you'll be able to pay it back with your rental income. People with a second home who don't live primarily in one of your communities, but who live in Seattle or Los Angeles or someplace, they, instead of leaving their home empty all the time, they could add an accessory dwelling unit where somebody would live there permanently. As long as there's a permanent resident, they can then rent out the main home when they don't want to be there personally. So it's a way to add leverage to add some additional accessory dwelling units that could be your workforce housing. You also could have, if there are homes that have been bought up and turned into dedicated short-term rentals, dedicated Airbnb homes, they would have to shift at least one of those rooms to be long-term rental in order to not have the penalties, or they wouldn't be able to participate with Fairbnb. So that can, again, create long-term rental options, which you need for workforce housing. And there's a number of other scenarios. Now, the strategy for short-term rentals is that you want to increase the barriers and costs to investor-owned short-term rental properties. So if nobody's living there, there's either a ban or there's high fees, or there's other things that puts them at a disadvantage. And it could potentially generate revenue to help support enforcing this and doing some of the other things. Then Airbnb, I've talked to some of their founders. They like the idea of having their entry into the United States being with a community or a group of communities that is building this into their sort of community-powered tourism strategy. So it's not just a few individuals, you know, signing up for Airbnb and nobody knows about it. Everybody just goes to Airbnb. But if you're branding it, you're using PR, your marketing, your communication is telling people about you've chosen an alternative to build a stronger community, that's going to help them be successful. It's going to help you be successful. And it could be part of building that local wealth and that more equitable and community-focused growth. So on the left here, we showed that if a guest, if the guest, I'm going to go through both these. If a guest pays, let's say, $67 for a night to stay in a home or an ADU, 15% of that goes as a commission, and 85% goes to the person, the host, so they would get $57. $5 would go to the community projects, and $5 goes to Airbnb. And that could be used where the LCINs provide a loan to, say, an equipment rental or equipment library that allows locals to get snowshoes or different things that they might normally not have access to. It could be a tool lending library for home renovation. They could support TREAD, which is focusing on trails in parts of Washington. And $5 a night, but if you have 100 nights and 100 homes, that's $50,000 a year that could be used to pay back an initial loan to get some of these things going. So that's a little bit how Airbnb can help create a short-term rental engine. So in your discussion questions, you can talk a little bit about how something like Airbnb rentals would be different from having a national chain at a hotel. If you say we want to have more people coming in and enjoying our beautiful part of the state and spending their money locally, let's have that money stay in the local community. The fourth, how can investors support innovative ownership models? Now, one of the shared ownership or shared equity models, you've got some good stuff going on in Washington, is community land trusts. And with the CLT, they end up owning the land, and the occupant of the home buys the house without having to own the land underneath it. And essentially that makes it a lot cheaper to buy the house, and it keeps it more permanently affordable. But the opportunity to bring in something new is a shared appreciation model. And a pioneer in this is a company called Landed, which started down in the Bay Area, but they've now expanded to the state of Washington, focusing on Seattle, but they're legal in the entire state. They just are focusing in Seattle right now. And what they do is they use a pool of investor money to jointly invest in houses along with the occupant. So what they'll typically do is make half of the down payment, and their focus is on essential workers, teachers, hospital staff, daycare workers, people who have full-time reliable jobs, but they just generally tend to not be enough to allow them to become a homeowner in a high housing cost market. So they're a co-owner. It's not a loan. They just have an equity stake in that house. And when the house is sold, or if they refinance at the end of 10 years, they get Landed gets their loan money back plus 25% of the gain or loss. So they share in that risk. And the occupant builds wealth because every month they're paying down a mortgage rather than just paying rent. And they do still get 75% of the appreciation into a home they otherwise couldn't have afforded. So LCINs could be partners in this, as they could help with the capital pool targeting these rural areas and smaller communities outside of Metro Seattle. Landed wants $5 million to start. That gives them the ability to do 150 joint investments of 30,000 each, or 30, fewer investments of a larger amount. based on what's appropriate for a half of a down payment in your community. So, but they also, to make this work for them, it's going to be best if it's part of a multifaceted strategy where shared appreciation is being built into the strategy, where you're educating some of the stakeholders and the first-time home buyers, and you're helping support economical renovations, and you're reducing the investor risk, perhaps with some charitable capital in the mix. So that is the fourth. And the fifth is creating a successful housing rental ecosystem. For this is where a strategy begins to create a common agenda among different stakeholders, including the businesses and others who need reasonable rental prices for their workforce and others, with nonprofits and other organizations that want to help serve and support people, and with landlords who want lower turnover and fewer headaches. This is something we pioneered in Detroit starting about 12, 13 years ago. And we've got a couple of the videos in the Housing Solutions Summit on communities of hope. And we built with them, with the residents, with the property managers, the owners, the staff, a strategy that was designed to enhance resident health, social connectedness, and well-being. We helped establish local nonprofits, healthcare. We didn't establish the nonprofits. Well, we did establish one nonprofit, but we worked with local nonprofit organizations, local healthcare providers, faith communities, schools, and businesses to work with the residents, and did all kinds of really cool stuff. Part of it was engaging the residents to say, how can they help create a better community and plan for their future? So we had things like community gardens and other things. And there's a lot of community building that can be done that is a win for everyone, including the property management firms. So you turn them from being the bad guys who are exploiting people to be the good guys who are helping people. And guess what? They can actually improve their profits by doing that. So there's, besides the larger apartment complexes, this approach could be done. We have not done it yet, but it could be done to support the mom and pop landlords to really say, hey, if you're working to help your residents, we're going to help you because we want to help the same people who happen to be living in your place, and life will be a lot easier for everyone if the property management or landlord is working with the other organizations. And it helps the renters to be stable and responsible and pay their rent reliably. And if you're looking at developing affordable rental apartments and you're putting together the investment profile and everything, building this in from the start can make a lot of sense, especially if you combine it with charitable capital, taking on some of the highest risk slice of the capital stack, with the LCIN investors who are willing to take a slightly lower return because of how it's building the community. And then you build in the communities of hope concept, which is going to help make these more successful. And so there's a variety of ways to increase the incentives and reduce the barriers to doing this kind of housing. So here, thinking about, are there property management companies that would be interested in learning how supporting residents and partnering with community-based organizations and local governments could actually increase their profitability while they're helping people do better, enjoy better health, and have upward social and economic mobility. And then are there community-based organizations that would be partnering with the property management firms to help accomplish that? Or nonprofit developers that would say, hey, we want to get the best of both of these, and we're going to have charitable capital, local capital, community-based organizations, all helping to make our apartment complex a community of hope. So those are the 5 areas that we wanted to kind of give you some initial information to talk about, break out into your breakout sessions, and then be able to come back and ask questions of me. So we're almost on schedule.
They're in the chat. So can you cite any examples where charitable capital is used to de-risk affordable housing? I think I got that right, correct, hopefully for the group.
Yeah, one of the sessions in the Housing Solution Summit that you guys have access to, the recording, is an organization called Yard Homes Minnesota. And they work with bringing together a manufactured ADU and adding that onto the property that's owned by a community land trust where there's already an existing house. And they used charitable capital. I think the numbers they got, I think they did get $250,000 from a Venn account, put it in a credit union, got $1 million to buy the first 10 manufactured accessory dwelling units, put those on the yards of these people who lived on the community land trust, and they teamed up with an organization that serves veterans. And so the veterans serving organization provided the social support wraparound services. The people who lived in the houses got a little extra revenue. It was all cash flowed, and it was made possible by the fact that they were able to get the charitable capital from the Venn Foundation to make it work. So it's like a 30-minute session, but it's a wonderful story and how that can allow them to scale up that wouldn't have happened without the charitable capital. Next question.
So the second one was, how large would an endowment need to be in order to be effective high-risk component of the capital stack?
I don't know. I don't, that's not my area of expertise to know. I know that it's in the capital stack, but to tell you what the proportion has to be, I don't have an answer to that.
It looks like Carla has her hand up.
I'm just reporting back from one of the group fours, if there were more than one, and saying that there was actually a pretty strong reaction to subsidizing the work of Landed, and a great deal of emphasis on creating our own, using that same kind of a model, but doing it locally or statewide. And then we had a wonderful discussion about how to capitalize on the model that is often used in immigrant communities and communities of color, where people get together and pool their money so that they can provide assistance for people in purchasing a mortgage or in paying their rent or whatever. How do we access that can-do model in a way that will work for other communities?
Yeah. I actually I had a long talk with one of the founders of Landed about them providing guidance to a nonprofit organization that would use their model to work with lower income people. And they're actually quite open to that. I was really pleased that it wasn't, a really profit maximizing. There are people who are really trying to do good. And even if it was not their organization, they did say that they spent a lot of money with lawyers and working out the systems and getting the software and everything in place to be able to legally and logistically handle this. And being able to provide that service is probably a lot cheaper than building it from scratch. But they were open to sharing their knowledge to get a nonprofit being able to do that in a market that's the lower dollars, that they're not really, isn't as much of a priority for them.
Okay.
Can I just ask a follow up with the communities of color question too?
Yeah, you bet. Sorry.
Yeah, I'm all for different types of mutual aid type things, but when it comes to financing housing, there's securities law and other things that oftentimes make things that compassionate people would just do together illegal. And so being able to navigate what's legal in coming together and buying a house, or being able to satisfy a bank to get a mortgage, it's not as easy as just let's all work together and help each other. There's a whole lot of ways outside of buying houses that kind of mutual aid approach can work. And one of the great examples that does involve housing, but was where someone would buy an old fixer-upper and others would help them build it, and you could have tool lending libraries and time exchanges and things, so that neighborhoods or communities that had a lot of older housing stock but you still have a person buying it and a person with a loan, and they might like give somebody free rent if they help them fix it up. But if you're going to actually have shared equity and shared ownership, there's a lot of legal and financial stuff that, whether you're people of color or not, you got to follow those laws.
All right, Bill, there's a question here from number 5. How do we create incentives to attract developers and property managers?
Well, I think my recommendation on that is to have show how the community can come together and support the residents to be more healthy, stable, jobs, reliable, so that the property managers and the owners of the property have fewer headaches and just a more stable business. And that's what we did in Detroit with Communities of Hope. Their turnover rate, it had dropped from very common 30-ish% a year to less than 10%. And their on-time rent increased dramatically, and their calls to the police dropped dramatically because they started building community. And they did that with the help of nonprofits, faith-based communities, and others that said, we're going to work together to create this as a place where neighbors work together, and we do gardening together, and we have walking clubs and dance things. The property management firm couldn't do that by themselves. And I believe that sharing that example to say, we've got case management, we've got different things that are going to help the renters be really good renters. And if you have really good renters, it's a lot easier to be a property manager or a landlord.
And I don't want to dominate because we don't have a lot of time, but that was from our breakout session, and the people that had watched the Detroit video, which is very inspiring. This question was more in the context of even just, smaller ADUs or small fourplexes and things of that nature, finding like you might be able to raise the funds to build it, but then who's going to manage it? Like if you use a local investment network, like nobody seems to want to step up and manage the development of it. And certainly anyone from the breakout session could chime in with their more specific questions or solutions.
Yeah, and I think trying to find, like in the example I gave earlier with the veterans, there was this organization called MACV in Minnesota. They were already helping veterans in a lot of ways. And so they're being willing, they took on a master lease. So they were the ones that was actually paying the rent. They sort of expanded their role to be sort of the rent liaisons with the veterans. So finding an organization that's serving the people, that's helping them, and having them take on a little bigger role to say, if you're going to put an ADU in your yard, you're backed by this trusted human services nonprofit that's going to help the person be reliable and pay the rent. And that organization is sticking out their neck a little bit because they believe they can help the person if they only could get them housing. Their biggest frustration was, we can do all the things to help these people, but there's no place for them to live. And so their life gets a lot easier if somebody will provide housing, and they can help fill that gap. So it's building, and usually it's not starting from scratch. It's finding an organization that could just expand what they're doing a little bit to handle that a little bit of the, whether it's case management or some of the property management. It may or may not involve them signing the master lease. It's going to vary from situation to situation, but you're trying to bring together partners to have everybody be more successful and reduce the risks.
Bill, there's a question here about rural communities. So what models exist to help finance infrastructure, water and sewer, particularly needed for ADUs on well and septic, like so outside of city limits and things like that?
I know one of the examples that we featured in the Housing Solution Summit was a couple on a septic system, and they added the ADU and they hooked it up to the septic system, and it was still economical for them. I don't know exactly the details. It probably depends on, the capacity of the sewer system, and if it's, the septic system, and whether it needs to be expanded if you're going to add an extra ADU. This was this case, they didn't need to do that. So I think you'd have to kind of just factor it into the budget.
All right. Let's see.
It looks
Sorry.
like Jordan has a question.
Hi, thank you, Lisa. Hi. So I was part of the group that Aslan mentioned with the question. Part of that was that, I would say in the post-COVID world, more people have home-based businesses that are truly home-based. They are not doing something fringe.
Right.
Have you had any reference or experience with, kind of the new crop of residents that are going to want to live somewhere long-term that will have businesses that are profitable, that, once they can reach the WSMA, they'll be investments. So do you have any, points of reference or direction on how that can be leveraged?
Mainly just from talking with some of the manufactured ADUs, companies that are manufacturing ADUs, they're saying that as many of them are being added as home offices in the backyard as they are residential. So that can help turn a house that has living space but not work at home space into one. So the ADU that may be used as a office rather than a residence. So I don't know, you probably wouldn't even call it an ADU. It's just an extra office that you're adding. But the pre-manufactured ones, I know some of them that's one of their best sellers.
Do you think there would be a way or a mechanism in which that you can kind of reflect the value of that unit, right? So if you put a unit in and that business is contributing, $10,000 a month, is there because that would show people that, hey, this ADU made money. It just didn't solve a problem. It actually produced X number of solutions.
In terms of being able to justify the financing or
quantifying it in a way that's digestible to people that need to see a return on an investment. I don't know what the specifics would be, but it seems like you have to show the work, so to speak.
Yeah, what I'm hearing is that it's as you're getting more creative things around ADUs, some of the appraisal is lagging behind a little bit. I know one of the speakers that we had from Los Angeles, he was an appraiser who specialized in ADUs because there were so many different configurations of ADUs being added, and they didn't have enough comparative, the comps that they used to value properties. So he said it was kind of an awkward stage that they often were under, they were appraised at below what was their realistic value because they just didn't have the track record to be able to assess what that additional value is. So I don't have a real good answer for that, although I think the appraisals will start to reflect creative uses of these sorts of things over time.
That direction is very helpful. Thank you.
I have a question about ADUs and renting them. It's a question that will not endear me to many people. It's a very difficult time to be a small landlord. And I can imagine that some people are avoiding putting ADUs and renting them because they don't want the hassles. Does anybody know about any laws existing or proposed that would make it easier or protect the interests of the landlord in the case of an ADU tenant going wild?
Yeah, I don't have a great answer for that. I think efforts to protect tenants often have put landlords in a more difficult position.
In this state in particular.
Yeah. What I think that a general strategy, if you do have the kinds of proactive supports that are helping the renters to succeed. And one of the other sessions that we did at the Housing Solutions Summit, we did a whole day on home sharing. And that's when you actually have people living in your home and you don't want them to, all of a sudden have somebody that you can't kick out of your home because they're actually living in your home, not even in an ADU. But they've had 500 plus matches. And she said probably on one hand, she could count the ones that they had to say, okay, this is not working out. The person's got to move out, and they had to find another place for them. But they were proactive in trying to anticipate the situation, what the needs were, and that they provided case management because they were dealing with pretty low income people. So I think you want to system thinking to say, depending on if you're trying to find housing for some of the lower income or some of the more challenging circumstances, you want to have more kind of wraparound supports to protect the interest, if you will, of a landlord, so they're not feeling it's too big of a risk for them to consider it.
I want to just add something. As being on both sides, I've lived in a mother-in-law suite, and my landlord literally was on opiates, and he was literally on, he was an alcoholic.
Yeah.
And for 2 years, I didn't know, because I lived there for 4 years. I didn't know until his wife left him of what happened. And so when his wife left him, I was stuck there as a tenant. And I'm not trying to be funny. I'm a Black woman and he was a white male. If he would have died, I was afraid. That's how afraid I was staying in that house. And it brings back trauma to me of like some of the things that was happening. And I think most of the problems have been in the Pacific Northwest is that people don't know how to communicate. And there's a big communication gap where most people say that I'm having problems with my tenant, but they don't know how to communicate before the problem get big. And so we're having all these communication problems. Two, people want the money, but don't want the problems that come with the money. I was paying my rent to this man, and I literally had cold water for 2 months because he was intoxicated on his couch. So when you talk about, and I'm glad I'm here, when you talk about, you need to talk about both sides.
Yes, good point.
And not only just talking about both sides, but understanding the duality of like what goes on when it comes about these situations. And the other one, I stayed in a house with her, that's the other person, and she was a person of color like I am. She was, I felt myself, I didn't know until I moved in, she was an alcoholic too. So, and you think you bring in, and I'm gonna talk about other things, you bring in the pandemic, you bring in everyone else is stressed out at the same time. And then you bring in the things that came before the stresses that no one dealt with before the pandemic about the actual problems with housing. And then you're like, oh, let me bring in these new alternative things that don't have nothing to do with how do we fix the current problem. So then you can make the investment on the things that are going on. So what I'm saying is, I think there needs to be a holistic like point of view and systems point of view of how we see things. Yes, you can get your money at the end, but everyone can get what they're looking for if we sit down and we have another way of thinking, because the way that you've been thinking, because of the non-diversity of thought process in the spaces, have gotten us down the road where we're now having to share bus rides with homeless people who will lighten up on on buses, and or having to literally I'm on the Renters' Rights Commission for Seattle. We're having people who are in like places where the actual person that's actually the management over the apartment, they don't know how to deal with the abusive people, tenants. So, I mean, you don't even know how to have a conversation or put something in place for when tenants, are stalking or harassing other tenants because of, again, we're stuck in the same place. So I think we need to figure out a better thing to this. I mean, I know you're trying to bring in more money for investments, but dude.
So
but yeah, I'm sorry to read it, but it's just like, yeah.
What I just want to say, Akita and Kita, is that your perspective is critical to this conversation. And I'm so glad you're here and that you've responded to the invitation. And secondly, until we can look at this issue from a multiple perspectives, diverse perspectives in income, cultural, ethnic, everything, we're not going to solve this problem. So I hope I would love to engage with you on how we can do this in a more holistic way. Yeah.
And throwing money at it ain't working.
Yeah, I agree. And the other thing is communication. There was a chat comment in here where Paul it has 5 houses, and his ability to communicate was central to making sure that that process of having tenants move smoothly. So I just want to thank you for your comments, really.
Yeah, there's
It's
also
not just getting them out, but it's saying, hey, I know that this is not working. We're both are at a place where I want to help you, but at the same time, it's eating at me also. How can we work together? And that's what my nonprofit is starting right now. I told you, Lisa, we were going to talk about it, but like, how do we help everyone on all sides? Because again, most tenants with a good heart, they hate to not pay. Totally. But it's like, how do you find a job that pays you what you're worth, and that you're going to work every day, and not having to like be a frontliner, and you have an educated, you have a degree that says that you need to be in another socioeconomic of like status of a job placement, and then you having to you get laid off and can't find a job. So there's a lot to this, and I'm finished. Sorry.
Thank you so much. Bill, go ahead. You were going to say something.
Oh, it was mentioned that the Housing Solution Network has a great video on how to be a good landlord, and they've got, it is good. I watched it a while back, and those educating both sides and trying to
Bill,
figure
have you
out.
been homeless? Have
No.
you lost? Like, no, I'm not trying to be funny.
Right.
Have you ever in your life have been in a place where you have like something happened and you lost everything, and you knew how long did it take for you to get back on your feet? Have that happened to you ever in your life, Bill?
Only very short term when I was traveling abroad once.
You were okay. Say that one more time. You were traveling.
I was traveling abroad, and I had my money stolen, and I was
traveling,
temporarily destitute. But it was a very different situation.
Traveling.
Yeah.
You were traveling, Bill. Yeah.
Well, I know. I'm not saying that's why we need different voices and different people. I don't bring all the lived experience, for sure.
That's what I'm trying to say. Like it's. This is what I do for. I'm gonna let everybody else finish, but like,
I'm just saying this is the conversation that we need to have, and I appreciate you bringing it forward. And we need these diverse perspectives, and I appreciate you being here.
Thank you. I'm finished. I'm done. But you guys don't understand. Like with so I have to do this work with my for-profit and teaching individuals of how to see other people as human beings, but still get what you need. But then on my nonprofit, having to literally look at the systems that are put in place to help everyone on the cycle of the wheel to get what they need, so that everyone have a win. It might not be a win right at that time, but everyone's on that timeline, and we'll receive a win whenever it's put in a timeline. So I think most people are in a space where it's like, okay, well, I'm just seeing what I need right now, but like how what I'm going through. But how do we come with different communities and understanding how do we help out these communities? You're coming from a community of investment, and that's great. We love investors. We love what you're doing, but at the same time, we need people who literally are in a space of saying, I want to invest, but then how do we make, how do we how do we balance this thing out? That's all I'm asking. Just a lens of like opening your heart to figure out, yes, you want to return, but at the same time, how do we look at this in a human-centered approach? So,
well, I think, and I'm going to stop here too, but I'll just say that the core of this is, helping more home ownership, so that people who are homeless or on the edge of homelessness can become homeowners, because nothing is going to reduce the wealth gap than that. And I'm going to stop talking. And I know there's a ton of questions in there, so thank you for all that. It was great.
Can I ask, well, I loved hearing what Ankita said, because I've lived in cities. I live in the Methow Valley, but I've lived in cities where I understand that situation very, very well. But I also think that we need, here in the Methow Valley, for instance, I don't know where we would find a property management person. And there are a lot of people who would invest in helping out people to become homeowners or renters, but don't want the hassle. And how do we do that if we can't find somebody who will take on the job of property management?
I got you covered. Just call me, but you need to pay me for my consultation. And I'm serious. Like, cause you're saying you don't know, I got you covered. You literally, I will put my information in there and I will help you figure out within your city who can be that main person, and not only be the main person, but figure out how do you create subsystems out of that will actually create you money at the end of, because again, it is a give and take. But I need you to pay me my consultation fee so that I can help you out, because again, that's how we will make it.
Yeah, that was not even the problem. I didn't even bring up the idea of payment for consultation.
No,
this is a very small valley, wait a minute, this is a very small valley, and we don't have a lot of expertise, and we don't have property managers per se. We need something like that.
But I'm saying I can give you that, but you need to pay me for giving you the information of what you're trying to create. That's what I'm saying.
See, I have another question, and I heard that somebody, you can't, can you all message each other? I just want to make sure you can do that and share your contact with Indy. Okay, good. Someone was having a hard time with that. Julie, was there a next question?
Yeah, so a question came out, how do we are there any deed restrictions or anything we can do to keep ADUs for affordable housing or for workforce housing? Have you seen any models in other communities? This is for Bill.
A couple examples. So the one that I mentioned where they worked with the Veterans Organization and the Community Land Trust, there were two things that kept that affordable. One is the way the funding worked. It was going to be affordable for the first 10 years based on the initial agreement, and then the home was going to go to, they actually give the home to the owner of the house on that community land trust lot. And because it's on the community land trust lot, that can have restrictions that keep it affordable. In other scenarios where an individual is just leasing a portion of their lot and allowing someone to put an ADU on it, I don't know that there are, I'm not sure that I've seen examples of how they keep that affordable and requiring it to be affordable. But I think the supply and the size of it and whether things are going to have a tendency to keep it, even if it's market rate, it's going to be smaller than, you know, renting a house or other things. And some of it's supply and demand. So that's still an emerging area to figure out ways to keep things well below market rates for people who that's all they can afford. But the community land trust option is a part of the way that can keep it affordable.
All right, thank you, Bill. Go ahead, Lisa.
Yeah, there was early on by Kelly Rupp about whether or not anybody had some insight on Senate Bill 50, I lost it already, 5846. Anybody tracking that in the legislature right now? 5648, I'm sorry. It's the prohibiting municipalities and counties from imposing owner occupancy requirements for ADUs. Just a question to the group.
Well, I'm not familiar with that specific bill, but I think it can be a common thing to try to use a policy tool to solve every problem. And if you don't want something, you want a policy to ban it. Instead of saying, what do we want? And let's build a strategy to work towards what we want. So the vast majority of situations will be better, and use things that are less blunt than oftentimes just passing a law to ban something, because that often is a kind of a reactive and not a very system thinking approach. So I don't know enough about that specific law, but I think it can be problematic when you use too broad of a brush to ban something, like banning evictions or things like that. It's like, well, that might help in the majority of cases, but what do you about there's enough cases where it's not appropriate. And same with banning. If you want owner occupancy in ADUs, meaning I think what their worry is that landlords these slumlords will then put a bunch of ADUs and have even more people crammed into their neighborhood. And they're saying that's what we don't want. We're fine with the homeowner having somebody renting in their backyard, but we don't want the slumlord, packing more people in and making the neighborhood even worse.
You're right, because we had at our forum, we had a renters' right forum for the Commission for People with Disabilities and all the other commissions. Like, somebody actually asked a question live, like, was it okay to they were charging people to live in their garage? Mm-hmm. That's how bad, some of these situations are. And they're like, can we kick them out? And they're like, and we had to bluntly say, like, we're hoping, sir, that we heard you wrong, that you were renting out your garage and or a storage. That was the second thing, a storage.
We have one more question here. Washington State property ownership is based upon the title. How does the ADU placed on an existing titled property work in Washington? Do you know anything about that?
I don't know about the state specific laws. I know California just did a lot of overhauling on that, but I don't know what Washington's.
What was that question, please?
The question was asking what happens to the title and I assume maybe it's with one of the models that Bill brought up, when somebody else puts an ADU on your property, who actually owns the ADU. I think maybe that's what he was referring to in Washington State.
Great. I have seen several examples of it, and there are several ways to do it. And it could be done in a number of numerous ways. And it depends on what the folks agree on and what the consensus is.
Yeah, one of the sessions that we did in the Housing Solution Summit on ownership or ADUs, I can't remember, I think they created a 2-unit condo. And so the property was owned by the condo association that had 2 owners. I mean, so there's creative ways of doing it using existing laws, and some of that varies from state to state.
That's just one of the ways. Legally, framework, you can do it several different ways, whether that be a lien, whether that be a co-ownership, whether it be making a home into a co-op, and also it could also be it's just like over a dozen ways come to my mind that I have my lived experience. I have seen it. I just wanted to share that.
That's great. Thank you. That's helpful. Do we have any other systemic questions? Any other for Bill, thinking about his developing an ecosystem and kind of thinking about this systems approach? I'm trying to think of see any broader questions here. Anybody can raise their hand if they'd like to, and then okay, I see Josh. Go ahead.
So just kind of piggybacking on Anquita's observations, and I believe it was Danny who had brought up the questions about landlords. The Low Income Housing Institute recently purchased a Tacoma hotel that's going to house, I believe, up to 800 unhoused individuals and families. The question is for Bill, do you have any reference of kind of an approach to transitioning people from being, unhoused to in a situation where they're housed long-term strategically so that they can transition into an ADU, but into being capable of living in a long-term residency? Are you aware of any other territories that have an infrastructure or resources or mechanism?
Not exactly in that situation, but there's a woman, Marcella Wilson, who led a large nonprofit in Detroit dealing with a lot of the poorest folks in Detroit. She developed a transitions to success model that really helps individuals kind of create their success pathway and then have different supports to help them on that journey. And she's built a whole program called Transition to Success. And they're now offering it through different communities and different ways. And a pretty remarkable success record. I mean, she's dealing with a pretty challenging population in many cases. And so it's not 100% successful, but significantly and, some pretty significant improvements in people who had been struggling for a long time, moving on to success and their kids moving on to success. But I think it takes individualized plans and wrapping people around. And that's where different community organizations and others can help. Not easy, but Transition to Success. Marcella Wilson was one of our presenters. I thought that was a really cool program that they had. And there's others that are more technology-based. Well-being Care Community is about connecting people with their individual success plans and a systematic approach to how they're making the most of resources in the community, rather than just the fragmented things that, you have an emergency crisis here and there's no thought about where am I trying to get to in a year, and helping people. It certainly seems better than not helping them to try to work towards a success pathway.
Thank you.
All right, Renita had her hand raised, and then Lisa's got an announcement, and then we are going to wrap it up here pretty soon. Renita, go ahead.
Yeah, I just wanted to add, in our group, I know I shared with individuals that the state is doing a lot under behavioral health with recovery residents, and they have funding that's available for nonprofits that's supporting individuals in their recovery journey with housing. So they're offering startup funds and calls for existing recovery residents or establishing a recovery resident. And then they're also encouraging providers are encouraging nonprofits for sustainability to become foundational community support providers. That is where Medicaid covers assisting individuals with providing supportive housing and employment services for that sustainability, to help individuals sustain housing. And that's where that piece can come in with working with landlords and encouraging them or letting them know that the individual that may have had barriers because of different physical or mental impairments in the past, and they were not supported, now that they have an organization that will be supporting them to sustain or secure housing, and also be there to help them sustain like 6 to 9 months after they have secured that housing, to make sure that the landlord know that they can be a resource that can support them and advocate for that tenant, but also support the landlord in connecting them to various resources through the landlord liaison programs that's offered at the state level. And I know in Pierce County, we have those resources as well. So that's a systems approach that I see Washington, the state is kind of trying to get a handle around, helping those in their recovery journey with behavioral health, with mental and substance use. So I just wanted to, bring that out and share that.
Yeah.
Thank you so much. That's a great.
Layla, I noticed you had your hand up, and you're welcome to go ahead, and then I'll do my announcement.
No, sorry, wrong button.
All right, good, no worries. So I just want to say how grateful I am that to Julie for putting all of this together, reaching out, getting Bill together here, finding sponsors, organizing this. You are awesome, and I'd love to give her a round of applause. So just unmute and go ahead. Bravo, bravo, Julie. Thank you so much. And I want to say thank you to you, Bill, for all your work locally, nationally, statewide, and I appreciate your time and energy to be here tonight.
No, I wasn't trying to be so hard on you. It's a lot. And it's not that I'm trying to be hard on you or I'm taking it out on you, but there are lived experiences, some of us have that are different. And it's like, if we don't speak up and if we don't talk about or have a dialogue about what's actually happening in these spaces, more people that are in your situation where, you know, you've been okay, like you wouldn't conceptualize it. You wouldn't know what's happening. So like, please don't be offended that I was like coming at you. It wasn't that I was coming at you. It's like a lot of trauma that have happened over the years of just being Black and a woman, and then doing well with my business, but at the same time having to like own my business and then also do the work on the side for free sometimes, or having to stay, you know, ahead. So I'm just saying, like, please don't think that I was just trying to like lash out on you or anything that.
I appreciate you voicing your thoughts and opinions.
How do we keep each other honest, and how do we stay transparent? That's just all.
Exactly. And I think that's why you and so many of you are, you know, we're all supposed to be here at this table, and I'm grateful that you're here. I also know I want to say thank you to Cherie. You had a huge burden, and we all got into our room. So thank you for your getting us here and getting us the links. Bravo. And then I want to say just a brief heads up. So there are local investment networks where people are investing in very small businesses all over the state. And there's an opportunity to learn more. In March, we have a workshop where Michael Schumann will come for 4 evenings in March. You can register. WSMA is sponsoring some tickets, so you don't have to pay. You need to apply. We'll have an application process. But if you want to learn more about that, join get onto the newsletter for WSMA. And gosh, I want to hand it back to you, Julie. Thank you.
I just want to say thank you to everyone who came and stayed with us at the end. You guys are amazing. And these are really important conversations. I know in all of our individual communities, like housing is a huge issue, and it's so personal. It's, you know, where we live is where our lives take place. So thank you so much. We will share all the links and all the information that came out of the chat box. We will try to get that out to you within the next week or so. And yeah, thank you so much for coming. I hope this was helpful. Right.
Yeah, and then
sign off.
One more thing.
Thank you.
There will be an evaluation, just a 10-question thing. If you'd fill that out, it would really be helpful to us. Thank you, everyone.
Have a great evening, you guys.
Thank you.
Bye.
Bye.